How life insurance policies are effected. Welcome to the Risk Management of Everything channel. On this channel, you will see videos on risk management and the application of risk management to diverse areas and sectors. If you are new here, make sure to subscribe to our channel and press the notification button so you can be notified when we upload new videos. Thank you. This video discusses how life insurance policies are effected. In this video, you will understand the meaning of life assurance, essentials of a valid life assurance contract, standard procedure of life assurance contract, life assurance underwriting procedure, proposal form, medical factors, medical underwriting, occupational factors, residential factors, financial factors, life insurance underwriting factors, and how to deal with under-average lives. Now, let us start. What is life insurance? Life insurance is a contract between two parties, known as the assured and assurer, which is a life insurance office, whereby the assurer undertakes to pay a lump sum known as a death benefit to the beneficiaries after the death of the life assured in exchange for payment of premium by the assured. Life insurance proceeds can be used for several purposes. Having life insurance can ensure that the assured's family can stay in their home and enhance their living standard. In some types of life policies, there is an option to get critical illness benefits or create additional protection for the assured family if he dies due to an accident. Life assurance is a vital tool for wealth management and tax planning. The favorable tax treatment and portability make a life assurance contract an invaluable tool for inheritance and succession planning, asset management, and tax optimization. Difference between life insurance and life assurance. It is beneficial to discuss the difference between life assurance and life insurance. The terms are used interchangeably in many parts of the world. These terms are similar, but they do not mean the same thing. Both are forms of protection designed to pay after the policyholder passes away, but they do not work the same way. There are three major differences between life assurance and life insurance. First, life insurance covers the assured for a specific period known as the term, whereas life assurance covers the assured for his entire life or whole life. Most term life insurance policies are purchased for a period, usually between 5 and 30 years. The policyholder pays a specified amount of money, monthly or annually, during the contract term. If the death of the life is assured, the life insurance will pay its dependents an agreed lump sum. On the other hand, a life assurance policy, also known as whole-of-life cover, is designed to last almost indefinitely or the assured lifetime. The implication is that life assurance guarantees that the beneficiary will eventually earn a payout, but a life insurance policy will elapse at the policy term. Second, a life insurance premium is usually lower as the benefit is payable only if the assured dies within the term. In contrast, the life assurance premium is higher due to the indefinite long-term and guarantee that the agreed benefits will be paid. Third, life insurance does include an investment element as it only has value in the event of a claim. In contrast, life assurance consists of both investment and protection elements. Life assurance pays out either a guaranteed minimum or its investment valuation, including the accumulated value of annual bonuses paid by the life assurance company when it is redeemed. Consequently, life assurance contracts help to ensure long-term and tax-efficient capital growth. Essentials of a valid life assurance contract. 5 requirements must be complied with for life assurance to be legally binding. They are: 1. Offer and acceptance. 2. Consideration. 3. Capacity to contract. 4. Insurable interest, and 5. Consensus addendum. 1. Offer and acceptance. The general law of contract applies to life assurance, but with certain modifications. The insurer's prospectus or advertisement is not an offer, but it is merely an invitation to receive an offer. The proposal form completed by the proposer is, by law, the offer. If prepared to accept the risk, The insurer considers the offer, will then issue a letter of acceptance stating that the policy will be issued. The first premium is paid within a specified time, on the understanding that the state of health of the proposer remains unchanged. The letter of acceptance is, at law, a counteroffer, which the proposer can accept by paying the first premium. Premium can be paid through direct credit or standing charges. In this case, it is considered that the receipt of a signed direct debit mandate or standing order is equivalent to the receipt of a check for the first premium as far as offer and acceptance are concerned. If the assured uses this right, premiums paid are refunded, and the contract is cancelled. The assured then has a 14 days cooling off period in which to change his mind under the cancellation notice procedure. 2. Consideration. A contract that is not under seal must have consideration to be valid, in the form of a premium. Almost all life policies are simple contracts. The consideration for which the contract is entered and created by the parties must be lawful. There must be lawful consideration to establish a legal relationship and to create obligation between them and enforce it by law. 3. Capacity to contract. Both the assured and the insurer must have the legal capacity to contract. There are certain restrictions on contractual powers for minors, mentally disorderly people, and companies. Let us consider the restriction of contractual powers of these three categories of personalities. 1. Minors. A minor or infant is a person under 18 years of age. Subject to certain exceptions, contracts made by minors are not enforceable against them, though minors may be able to enforce them. Contracts for necessaries and specific contracts of employment benefits to the minor are enforceable. Other contracts are valid unless the minor repudiates the contract before the age of 18 or within a reasonable time. Insurance policies fall within this class. A minor can propose a life policy if they are old enough to know what they are doing. The minor can then repudiate the contract within a reasonable time of attaining 18. Thus, most life offices will not do business with proposers under 18. Some will be subject to parental consent, although this would not stop the minor from repudiating the contract at age 18. 2. Mentally disordered people. Generally, a contract with a person of unsound mind is binding on that person if the other contracting party did not know the disability. Consequently, an insurer should not grant a life policy to a proposer known to be of unsound mind. They could repudiate the contract if the disability were known to the other party. 3. Companies. A company is a legal entity distinct from that of its members. The power of a company to contract is contained in its memorandum and articles of association. Contracts that are neither expressly nor impliedly authorized are ultra vires and void. 4. Insurable interest. The proposer must have an insurable interest in the life assured. Before the Life Assurance Act 1774, this was not necessary. The lives of criminals and notorious people were insured by people unconnected with them, with the expected of making a substantial profit on their early death. Insurable interest arises from a financial relationship between the insured and the event covered by the life insurance contract. In a life assurance contract, a person may have an insurable interest in his own life and the lives of his relatives, including his wife, son, and daughter. No person can purchase a life insurance policy for a third person unless he or she has a financial interest in the life assured. 5. Consensus ad idem. Consensus ad idem is a Latin maxim that means complete agreement of mind or same mind. There must be free consent between the parties to the contract, known as the assured and the assurer. Consent means that parties to an agreement must agree on a specific thing in the same sense, or their understanding should be the same. Consent must be given voluntarily by the parties to the contract, without any fear and favor. Consent is known to be free if it is not obtained by fraud, misrepresentation, mistakes, and undue influences. The law imposes on the proposer the duty of utmost good faith or uberum fides to disclose all material facts to the insurer. The duty of disclosure on the part of the proposer continues until the commencement of the contract and the payment of the first premium. If the proposer fails to disclose a material fact, this renders the contract voidable at the insurer's option. The insurer must also observe bona fides to ensure that the parties are on the same level of knowledge about the contract. Why do you need life insurance? A person can purchase a life insurance policy to assist and sustain his family and estate in the event of the death of the insured person for planning and investment purpose. It is beneficial to obtain or purchase an appropriate life insurance policy to provide benefits to people that rely on your earning capacity. Life insurance policies can also be taken up to pay outstanding house purchase mortgages and raising of funds for investment purposes. It is also possible to purchase insurance policies to cover the living expenses of your children who are university or college until they are financially self-sufficient. There are several benefits of life insurance. Here are some of the reasons why you need life insurance. 1. Illness protection. As a person prepares for retirement, life insurance policies that cover critical illnesses become essential. Some life insurance policies offer valuable features that cover the assured from severe ailments like heart attacks and cancer. Buying these types of policies can protect you from some of the most common deadly diseases. 2. Family support. If you have a spouse and kids, it is necessary to support them. You would want to protect them from financial hardship in case of your untimely demise. You can also get good returns with life insurance by investing in some policies to provide significant benefits for your family. 3. Savings growth. Some life insurance plans can be a valuable way to save and invest your money in your early working years. Universal life insurance policies or unit-linked life insurance policies allow you to invest in equity and debt markets. You might also be able to secure tax benefits for life insurance payouts. Tax laws in many countries allow tax benefits for investment in life insurance policies and the maturity amounts of such policies. 4. Debt. We often take large loans in our working life, especially when buying a house. An untimely death while a loan is still due can have substantial economic consequences for our families. In such a scenario, life insurance money can be used to pay off the loan. For example, decreasing term assurance can be purchased to offset outstanding mortgage debt if the breadwinner dies before paying the total mortgage loans. Life assurance underwriting. Underwriting is a process of assessing a proposal and deciding whether to accept the risk and, if accepting the risks, at what rate and terms. The proposer must complete a proposal form, and the completed proposal form forms the basis of the life assurance contract. The premium rate is usually based on assured and varies with the age of the proposal and terms of the policy, that is the type of cover including term assurance, whole life, and endowment. The ordinary rate is based on the average mortality experience. Suppose a life proposed shows features that suggest that there is an above-average risk of death. In that case, the insurer will investigate and decide whether the risk can be accepted at ordinary rates or whether some special terms might be required. The proposal form completed and signed by the proposer constitutes a request to the life office to issue the desired policy to the insured. Life assurance underwriting procedure. As explained earlier, the insurer's prospectus or advertisement is not an offer, but it is merely an invitation to receive an offer. The proposal form completed by the proposer is, by law, the offer. If prepared to accept the risk, the insurer considers the offer, will then issue a letter of acceptance stating that the policy will be issued. The first premium is paid within a specified time, on the understanding that the state of health of the proposer remains unchanged. Proposal form. Submission of a completed proposal form is the initial stage of life assurance underwriting. The completed proposal form constitutes a request by the proposer to the life office to issue the desired policy. Life assurance proposal forms usually consist of three major sections. 1. The section that identifies the life to be assured. 2. The section that specifies the details of the contract required, and 3. The section provided the details of the life risks. The declaration, located at the end of the form, must be signed to affirm that the information provided is accurate and give the insurer permission to seek the doctor for further information. Life assurance always considers some factors during underwriting, including medical, occupational, residential, and financial factors. Medical factors. If the proposal form reveals any medical factor, the insurer may request further information. This is referred to as medical underwriting. Medical underwriting is an insurance term that refers to the use of the medical or health history of the proposer. Further medical information can be secured in two main ways, through 1. Medical attendance report, from the proposer personal doctor, and 2. Medical examination. The proposal will be subjected to a medical examination. Most life offices have lists of doctors, and the proposer will be asked to contact the doctor and make an appointment. The first part of the medical examination report is completed using the information provided on the completed proposal form. The second part of the report is completed based on the results of the examination. Medical underwriting. Medical underwriting is a life insurance term that refers to using the medical or health history of a life insurance applicant. When an underwriter assesses the proposer application, he and she may be asked to complete a medical examination depending on the information provided. Medical exam is often necessary to provide the underwriter with accurate depictions of health status. Medical history from the proposer's doctor or other medical professionals would be obtained with his permission, and any information gathered should be treated in confidence. Some medical conditions would prompt an insurer to request a medical report from the proposer's doctor and medical examination. Such conditions include heart problems and high blood pressure, chest pains, lung disorders, bronchitis, chronic indigestion, diabetes, malignant tumors or cancer, kidney, bladder, liver disorders and stones, hepatitis, mental illness, epilepsy, and human immune deficiency virus, HIV. Occupational factors. The occupation of the proposer may also be material for underwriting purposes. The underwriter will look at the occupation to see whether it presents a greater than average risk of death. Some occupations may result in a higher than, above, average risk of death by accident, while others may predispose a person to a high risk of disease. Examples of occupations with an above-average risk of death by accident include scaffolders, underground miners, divers, chemical workers, asbestos workers, oil rig workers, bomb disposal workers, handlers of radioactive materials, motor and motorcycle racers and professional boxers. Some above-average risk occupations may lead to some form of special treatment. Improvements in working conditions and better safety measures may make many occupations to be safer. Safety regulations usually minimize disease risks, and the underwriting treatment will vary from office to office. Residential factors. Residential factors, including climatic risks, used to be very important in life assurance underwriting, but are now much less significant. The advances in transport, medicine, and public health have minimized these risks over the last few decades, and there have been wide-scale reductions in residential extras. Some residential areas may present additional risks. These risks may arise from political instability or warfare. Evidence of residential factors is evident in Africa, Middle East, Asia, and Europe due to increased terrorist acts, suicide bombing, religious fanatics, civil unrest, and natural disasters. Tropical countries may produce different health risks because of tropical diseases, poor sanitation, and less sophisticated medical facilities. Financial factors. Underwriters should also consider financial factors in their underwriting. For instance, where the sum assured looks very high for the circumstances of the life assured, the insurer should consider the ability of the assured to pay the premium consistently. If a high-value policy is proposed on the life, the insurable interest situation should be checked carefully by the insurer. This is necessary to affirm that the proposer has an insurable interest in the life assured of at least the amount of the sum assured. If a high sum assured is proposed, the underwriter should consider the possibility of a fraudulent claim. There have been cases where individuals have insured themselves for large amounts with some life offices and then faked death to enable an associate to defraud the life office. Life assurance fraudsters can be combated through a collaboration of life offices under the umbrella of insurer associations. Life insurance underwriting factors. Not every person presents the same degree of risk to life offices. For instance, a young man of 30 years old in general good health would provide a significantly lower risk of early death than a man of 60 years of age or ill health. There are, however, no certainties in life because a younger person could die earlier than an older person. Hence, life assurance is based on calculable risk, and that is what underwriters do. Numerous factors will be considered when underwriting a life insurance policy. First, an underwriter will need to determine the probability of a proposer's life lasting as long, or even longer, than the average life expectancy for an individual of that age and gender. In this estimate of life expectancy, if the proposer were to live as long or longer than anticipated based on the mortality table, then the funds that the assured has paid into the policy in the form of premiums will typically create enough investment for the insurer to take on the risk. This means that even after the assured has died, the total amount of premium that he or she has paid over time, combined with such funds invested return, that is bonuses, will be more than what the insurer will pay out in the form of a death benefit on the policy, thereby resulting in a profit to the insurance company. Hence, underwriters, insurers, also need to analyze factors that could lead to the death of the proposer before his or her average life expectancy. Such factors could include a family history of health impairments such as cancer or stroke and external factors such as working in a dangerous occupation. Here are major factors that life offices will consider before granting you a life insurance cover. 1. Type and amount of policy. Many different life insurance policies offer different coverage terms, payout structures and investment options. Term life insurance, which provides coverage for a set term, usually 30 or 40 years, when the insured person expects to reach retirement age, is the simplest type of policy and generally has the least expensive premiums. The premium payments for a whole life insurance policy are considerably more expensive for the same death benefit. That is because, unlike term life insurance, permanent life insurance comes with a guaranteed death benefit. For instance, the premiums for a whole life insurance policy will cost 6 to 10 times as much as a term life policy for the same death benefit amount. Another critical factor is the amount of the death benefit. The higher the death benefit coverage, the higher the premium payable by the assured. 2. Proposer's age. Age is an essential factor in determining the cost, as a younger person will make payments for many years before cashing out. Hence, the younger the proposer, the lower the premium payable by the proposer. This is because life insurance is a calculated risk. For instance, if an assured buying a 30-year term life insurance policy, the insurance company will compute the mortality or the insured chance of being alive 31 years from now. The younger the assured, the greater chance that he will be alive in 3 decades. Therefore, some bachelors and spinsters in their 20s decide to buy life insurance even if they have no immediate plans to get married or have children. They want to benefit from a low rate early to save later when they have a family. 3. Proposer's gender. Men pay more for life insurance than women. Why? Simple math. Women live 5 years longer on average than men. That alone makes women a lower life insurance risk than men. Nevertheless, there are factors other than life expectancy that make men riskier than women. Men undertake more dangerous jobs, have more dangerous hobbies, are more likely to drink and do drugs, climb ladders, and drive too fast. Not every man is a construction worker with a drinking problem, but insurance rates are primarily about averages, not individual cases. 4. Proposer's health. Life offices often accept medically underwritten life policies at the best rates. This means that the insurance company might send a nurse to an assured's house to take his height and weight, measure the blood pressure, and ask series of questions about his physical and mental health. The better the overall health of the assured, the lower the premiums payable by the assured. The proposer must be honest about his or her medical and family health history. It is better to pay a higher premium than to have a death benefit denied due to insurance fraud or non-disclosure. 5. Proposer's smoking and tobacco usage. Smoking and regular tobacco usage are harmful to human health. Life insurance companies take smoking and tobacco so seriously that they offer different tobacco and non-tobacco users rates. The premium of an assured that uses tobacco will be more expensive, even if he or she does not have any other health problems. To be considered a non-smoker, most life insurance companies require the proposer to be tobacco-free for at least 12 months. If the assured quit smoking after the commencement of the life insurance contract, he might request to go through the health underwriting again to get a lower rate. 6. Proposer's family health history. Suppose the proposer has a family history of health problems, like multiple family members with diabetes. The proposer will be required to disclose the medical history of his or her immediate families, such as the parents and siblings. This could increase the life insurance premium because the insurer might be concerned that this could result in critical health problems. Having a terrible family medical history will disqualify a person from purchasing life insurance, but the person might be required to pay a higher premium. 7. Lifestyle and occupation. The proposer will also be required to disclose information on his job, hobbies, and lifestyle. If the proposer works in a dangerous field, he will be expected to pay higher premiums for the additional risk. If he has any dangerous hobbies, like skydiving or race car driving, this could also increase the premium payable. The insurance company could also check the proposer's driving and criminal records. Having an endorsed driver's license and criminal records could lead to the payment of a higher premium or an outright denial of life insurance cover. 8. Riders. A rider is an insurance policy that allows a policyholder to secure additional benefits, as an extension or a separate cover, beyond the cover provided by the original policy at an additional premium. This implies that when a person purchases a life insurance policy, he or she is likely to have the option to add additional features to the policy through a policy rider. The additional benefit will attract the payment of an additional premium. 9. Proposer's weight. Excessive weight is an additional risk. Because obesity can lead to a shorter life, the premium payable by the assured with excess weight will be higher. 10. Proposer alcohol drinking habit. Alcohol drinking is injurious to human health in several ways. A policyholder who is a heavy consumer of alcohol will be required to pay a higher premium. The heavier the proposer's drink, the higher the risk poses by the proposer's life. 11. The sum assured of the existing life insurance policy. Proposers with more life insurance than necessary are generally considered poor risks to an insurance company. Hence, life insurance companies always require the proposer to disclose the amount or sum assured of his existing life policies. This may be a pointer to potentially fraudulent claims. 12. Proposer's income. Income can assist an underwriter in determining the suitability of the amount of life insurance. Knowing the proposer's income would help determine whether the premium payable is reasonable or not. 13. Amount of foreign travel that the proposer does. Some types of foreign travel and geographical location are considered risky. Different risks are present in diverse geographical locations. Risky foreign travels attract payment of higher premiums by the assured. All the underwriting factors discussed above constitute elements of risk. Each will be analyzed and considered by the life office before accepting or rejecting a proposed risk. Proposers whose proposals are rejected due to high risk factors can still purchase life insurance, provided they can pay higher premiums. How to deal with under-average risks. Having completed the underwriting process, those lives accepted at ordinary rates are termed average lives or standard lives. Those assessed as having a higher risk of death than an average risk is known as under-average lives or substandard lives. Each proposer should pay a premium appropriate to the risk run by the life office. Hence, under-average lives should pay a higher premium than the standard premium, an ordinary rate plus an extra premium. Extra risks can be classified into three categories, namely 1. Increasing extra risks. The risk increases with time, for example, overweight. 2. Reducing extra risks. The risk is at its greatest at the outset and reduces over time, for example, tuberculosis. 3. Constant extra risks. The risk is constant while life is exposed to risks, for example, aviation risks and motor racing. Under average lives underwriting measures. Methods of dealing with under-average lives include 1. Ordinary rates for limited policy types. If the risk is an increasing one, many impairments are accepted at an ordinary rate if the policy expires before a certain age. 2. Exclusions. The proposed risk may be accepted at ordinary rates, but death arising from the additional risk, for example, death caused by motorcycling racing, will be excluded from the coverage. 3. Monetary extra. The monetary extra is an extra premium expressed in a specific amount pay a $1,000 sum assured. 4. Postponement. This method can be used where the initial risk renders the life virtually uninsurable, but where once the danger period is survived, prospects will improve substantially so that acceptance at an ordinary rate might be possible. For instance, these methods are suitable where the proposer is having an operation shortly, after which the life insurance application can be resubmitted. 5. Declination. The proposal may be declined outrightly if the extra risk is significant and there is a small prospect of improvement later. However, the proportion of cases declined by life offices is very low. Conclusion. This video has explained how life insurance policies are affected. Life assurance is a vital tool for wealth management and tax planning. Life insurance proceeds can be used for several purposes. Having life insurance can ensure that the assured's family can stay in their home and enhance their living standard. In some types of life policies, there is an option to get critical illness benefits or create additional protection for the assured family if he dies due to an accident. Life assurance is a vital tool for wealth management and tax planning. The favorable tax treatment and portability make a life assurance contract an invaluable tool for inheritance and succession planning, asset management, and tax optimization. I hope the video is educative and beneficial to you. We love to hear from you. Kindly post your comments below in the comments section. If this video has been helpful and beneficial to you, then give it a thumbs up and share it with your friends. Thank you for watching the Risk Management of Everything videos. We love to hear from you. Please post your comments and questions in the comments section below. If you are new here, make sure to subscribe to our channel, Risk Management of Everything channel, and press the notification button so you can be notified when we upload new videos. Thank you.